Welcome, dear traders. The start of the new trading week in the Asia-Pacific region was mixed. On the one hand, assets continued to follow Wall Street sentiment and the US dollar's moves to the US jobs report. At the same time, economic data from Japan and China waned on the market. In addition, the sentiments and concerns that resurfaced along with the publication of a fresh data also affected assets today. Stronger than expected data on the US labor market diminished optimism expectations of an imminent Fed rate cut. November's Nonfarm payrolls not only exceeded forecasts for the number of new jobs, but also showed high rates of wage growth. As a result, the greenback received double support. A strong labor market will allow the Fed to maintain its hawkish stance for longer. On the other hand, rising wages could cause inflation to pick up, forcing the Fed to act more aggressively. As a result, the US currency made several sharp volatile jumps following Friday's Nonfarm payrolls release, and today in Asia it consolidated near the 104 mark. The US dollar index traded within the range of 103.90 and 104.10. Most likely, the greenback's flat will be short-lived. Looking ahead, Tuesday will bring report on the US consumer prices and the Federal Reserve's interest rate decision on a Wednesday. The level of 102.60 offers support, while resistance levels are located at 104.70 and 105.50. Today, investors are increasingly concerned about the Chinese economy. It appears that Beijing's measures to stimulate and support the economy are either ineffective or have yet to fully take effect. Anyway, consumer prices in China dropped at the fastest pace in 2 years in November to minus 0.5%. This is the highest reading since November 2020 and suggests a sharp drop in domestic demand due to falling incomes, given that deflation also means falling output and a weakening labor market. Meanwhile, core consumer prices, which exclude food and energy prices, rose by 0.6% year-on-year in November, the same as in October. Japan's third quarter GDP data released on Friday continues to be alarming. The data showed that the country's economy contracted to minus 2.9% year-over-year and remained very fragile. Today's economic reports also did little to improve market optimism. The reports showed that new orders for machine tools in Japan plummeted by 20.6%, the biggest drop since June 2023. In addition, both domestic and foreign demand slipped by 24.5% and 18.8% respectively. Considering that this sector represents one of the leading industries in the country's economy, its contraction has increased fears of a possible recession in the future. Therefore, a rate hike by the Bank of Japan looks less probable. All the more so as the markets have received clarification on the Bank of Japan governor's recent supposedly hawkish comments. They say that Kazuo Ueda's words were taken out of context and did not signal the timing of the regulator's ultra-loose policy shift. Last week, the Japanese yen surged by 3.5% on a hawkish comments from the Bank of Japan governor. On Monday, it began the trading session with a sharp depreciation, and this compares to a 4-month low of 141.70 last Thursday. At the beginning of Monday, the dollar-yen pair jumped as high as 146.40 yen. Today, despite a slight pullback, the pair still remains bullish momentum. During the Asian trading session, the pair remained within the 144.70 and 146.50 range, and the next resistance level for the pair is at 146.60. The strengthening US dollar forced the antibody currencies to retreat deeper into bearish territory, and today the Aussies traded between 0.6551 and 0.6587. However, the Australian dollar did not only retreat against the stronger greenback. Disappointing China's economic data and the lower oil prices also wind it down. However, the Aussie dollar pair averted a sharp decline in the Asian trading session and consolidated near 0.6562. Most likely, the Aussie anticipates Michelle Bullock's statement. The head of the Reserve Bank of Australia is scheduled to speak tomorrow, and her comments may support the country's currency against the US dollar. The New Zealand dollar may receive a boost amid the growth of Aussie. However, the Kiwi is trading under the influence of the same downward factors as its Australian counterpart. Therefore, the Kiwi dollar pair continued to decline for the second session in a row, trading near 0.6111 today, and the 0.6053 support level may see more bullish demand. And that's all for now. Stay tuned for more updates with the InstaForex TV. We appreciate your feedback. Please leave your questions and comments below, and see you online soon.